Let me tell you something that should make you deeply uncomfortable. In 1637, Dutch investors were paying the equivalent of a skilled craftsman's annual salary for a single tulip bulb. Not a field of tulips, not a tulip farm, one bulb. And the crazy part? It wasn't random peasants doing this. It was merchants, traders, educated professionals who genuinely believed they were making rational investment decisions. Sound familiar? It should, because here's the thing. We like to look back at historical financial crises and laugh. The tulip bubble, the South Sea Company, the railroad mania of the 1840s. We treat them like historical comedy sketches, like people back then were just dumber, less sophisticated, more gullible. And that's exactly the kind of thinking that gets you wrecked. Because the uncomfortable truth is that every single financial crisis in recorded history, and I mean every one of them, follows the exact same 4 steps, same structure, same psychology, same ending. Every single time. The names change, the assets change, the decade changes, but the script is identical. And I'm not talking about vague platitudes like greed is bad or markets go up and down. I'm talking about a specific clinical repeatable sequence that plays out with terrifying precision. And once you see it, you cannot unsee it. Which is either the most useful thing I've ever told you or the most disturbing, depending on how you feel about watching a slow-motion train wreck that you already know is coming. So let's break it down. Step 1 is what economists call the displacement, and it always starts the same way. Something real changes, a genuine innovation, a policy shift, a new technology, a new market opening up. Something actually legitimate happens that creates a believable reason to get excited. This is important because financial bubbles don't start with lies. They start with truth, and that's what makes them so dangerous. In the 1840s, the railroad was genuinely revolutionary. It compressed distances, transformed commerce, and reshaped entire economies, real, legitimate, transformative. In the late 1990s, the internet genuinely changed the world, not a fantasy, a fact. In 2003, housing prices had been rising for years, and interest rates were low, and the economy was growing, also real. The displacement is always anchored in something that actually happened. That's the bait, and it works every time because the bait is real. Step 2 is the boom. And this is where things start to get weird. Because once the displacement happens, capital starts flowing in, slowly at first, then faster, then so fast that nobody can explain it anymore. And here's the mechanism that nobody talks about. The boom feeds itself. Rising prices attract more buyers push prices higher. Higher prices look like validation. And suddenly, the original legitimate thesis, railroads are revolutionary, the internet changes everything, gets hijacked. Because now it's not about the technology anymore. It's about the price going up. In 1720, the South Sea Company was granted a monopoly on British trade with South America. Real business, real government backing. And within months, the stock went from £100 to over £1,000. A 10x increase in months, with no actual profits to show for it. Because by then, nobody was buying the company, they were buying the price. And when you're buying the price instead of the asset, you've already crossed a line you can't see. And this is also where a very specific thing happens. The smart money gets in early, gets very rich, and starts to quietly question whether this makes sense. But then they look around, see prices still going up, and convince themselves they're wrong. It's the phase right before the actual Minsky moment, where sophisticated investors who know better keep playing anyway, because the music hasn't stopped yet, and nobody wants to be the first one standing when it does. Step 3 is the euphoria, and this is the one that should scare you, because step 3 is when it stops being a market and starts being a religion. This is the step where PE ratios stop mattering, where experts say, this time it's different on television with a completely straight face, where your coworker who has never invested in their life opens a brokerage account. In 2000, a company called Pets.com raised $82.5 million in an IPO. Their business model was selling pet food online at a loss and hoping to make it up in volume. Their stock doubled on the first day of trading. It went bankrupt 9 months later. But here's the insidious part of step 3. The euphoria doesn't just affect retail investors. It infects institutions. It infects analysts. Because when everyone around you is printing money and your fund is underperforming because you're being cautious, the pressure to abandon caution becomes almost unbearable. The smart money starts chasing the same thing everyone else is chasing. And at that point, the entire system is one big feedback loop with no circuit breaker. The Nifty 50 stocks in 1972 were trading at an average of 42 times earnings. The S&P 500 in early 2000 was trading at over 30 times earnings. U.S. housing prices from 2002 to 2006 increased nearly 60% nationally. And in every single case, credentialed, experienced, respected people were making arguments for why those valuations were justified. Because that's what Euphoria does. It doesn't make you feel irrational. It makes irrationality feel obvious. Step 4 is the crash, and this is almost anticlimactic compared to everything that came before it. Because by the time the crash happens, the damage is already done. The crash is just the moment the math wins, and the math always wins. What triggers it almost doesn't matter. In 2008, it was a few subprime mortgage defaults that nobody was supposed to notice. In 1929, it was a margin call. In 1637, it was a single tulip auction where buyers simply stopped showing up. The trigger is never the point. The trigger is just the first domino. The real damage was engineered during steps 2 and 3, when leverage piled up, when assets were priced for perfection, and when everyone made the same bet at the same time. The average loss in a major financial crisis isn't 10 or 15%. The Nasdaq lost 78% between 2000 and 2002. U.S. housing lost up to 60% in certain markets between 2006 and 2012. The Dutch tulip market lost roughly 99% of its value in 1637, and in every case, the people who got hurt the most weren't the ones who got in first. They were the ones who got in during step 3. The late arrivals. The people who finally convinced themselves to join after watching everyone else get rich. They always catch the knife. Now, if you've been paying attention, you might be wondering what step we're in right now. And I'm not going to tell you this is a bubble. I'm not going to tell you things are fine either. What I will say is that the Magnificent Seven currently make up over 35% of the entire S&P 500. 7 companies. Several of them trading at valuations that would need decades of flawless execution to justify. The narrative around AI is real, genuinely real. Just like the internet was real in 1998, and railroads were real in 1845, the technology matters. But the price you pay for it also matters. And right now, a lot of people are confusing a real narrative with a guaranteed return. And here's the part nobody wants to say out loud. We are not smarter than the Dutch merchants who paid a year's salary for a tulip bulb. We're not smarter than the people who loaded up on pets.com or interest-only mortgages. We have the same hardware, the same fear of missing out, the same ability to construct a perfectly logical narrative that justifies doing something insane. The reason history keeps repeating isn't because people are stupid. It's because the emotional architecture of a financial bubble exploits the parts of human psychology we can't easily override. The fear of missing out is more powerful than the fear of loss. Social proof beats data every time, and he feeling that this time is different, and it's almost impossible to shake when you're in the middle of it. Which brings us to the only question that actually matters. Not whether a crash is coming, not when, but whether, when you're standing in step 3 with everyone around you, talking about how obvious this all is, you'll recognize it, or whether you'll be the person someone writes about in a video 50 years from now. Because the market doesn't care about your narrative. At some point, gravity shows up. It always does. So I want to know where you think we are right now. Are we in step 2 with real room to run? Or are we already deep in step 3, too euphoric to see it? Drop your take in the comments, because that conversation is always more honest than anything you'll see on financial television.